Hello and welcome to the Capital Contrarian. In this video, we'll cover what book value, market cap, and enterprise's value mean, and the importance of these valuation metrics. So let's get right into it. When valuing a company, investors and analysts ordinarily use a variety of metrics to quickly see a company's current value. In this video, we'll explore the differences between these three metrics and why it's important to have an understanding of the three. Let's start with book value. This metric represents the net value of a company's assets. It's a simple calculation in which you subtract a company's liabilities from its assets. Book value is often used to quickly determine how much a company would be worth if all of its assets were sold and all its liabilities were paid off. One of the advantages of using book value is its simplicity, and that it's based on actual accounting numbers, making it a relatively reliable measure of a company's net worth. However, in most cases, it will not fully capture the value of intangible assets, such as intellectual property, that are not reflected in a company's accounting records. You'll see this metric is frequently used for companies in the financial industry and companies in low growth or late life stages. Market capitalization, or market cap, is a metric that represents the total value of a company's outstanding shares of stock. It's also a pretty simple calculation in which you multiply the number of outstanding shares by the current share price. Market cap reflects the value that investors place on a company's future earnings potential and the expectation of the future equity worth. Like book value, this is a metric that can be easily found. You get a current look into what other investors are valuing the equity portion of the company at that exact point in time. This is very helpful when understanding how the market sees the company. Finally, we have enterprise value. This metric represents the total value of a company, including its equity and debt. It is calculated by adding a company's market cap to its total debt and subtracting its cash and cash equivalents. Enterprise value reflects the true cost of acquiring a company and provides a more accurate picture of its value. One of the advantages of using enterprise value is that it takes into account a company's net debt, and this can significantly impact its value. However, it can be complex to calculate and requires accurate information on a company's debt and cash positions, which can go through significant changes from quarter to quarter. So it's important to review the most recent financial data that the company's presented to get the most up-to-date numbers. Now we can cover some of the reasons why these are commonly used and why I think all three are important and should be used congruently. The key differences between these three metrics are the underlying assumptions and calculations used to arrive at each one. While book value focuses solely on a company's assets and liabilities at a singular point in time, market cap will give you insight into how the general investing population is valuing that particular company. Enterprise value grows on that idea, but shows you the acquiring value by taking net debt into consideration. In general, book value may be more appropriate for valuing asset-heavy companies, while market cap and enterprise value may be more appropriate for valuing companies with a high growth potential or if they have significant amounts of debt. I hope you enjoyed this episode of the Valuation Metric series on the Capital Contrarian. Let us know your thoughts on these metrics in the comment section below, and please check out the upcoming videos in this series. Don't forget to like and subscribe. Thanks for watching, and have a great day.